John Bartlett with Brentwood Growth. We've got our podcast, Sell or Scale, and I'm pleased to have with me today Matt Raimondi. Matt, how are you today, man?
I'm doing well. I appreciate you having me on.
That's right. Well, glad to have you. Tell us a little bit about your background and a little bit about Silvermine Growth Partners and how you guys sort of came together and what is it that you guys are looking for to invest in or to partner with.
Sure, happy to. So I've been an investor for 14 or 15 years or so. Started my career as a consultant and worked for a couple other pretty big PE firms. And then started Silvermine with my friend and co-founder, a guy named Michael Fisher, about a year and a half ago. And when Michael and I founded Silvermine, the key thing for us is we are very mission-focused guys, and the mission is front and center. And that is, if you invest in the employees will take care of the customers, and that will take care of the financial results. So all of Silvermine is kind of behind that thesis. We tend to focus on a couple key areas. So one big bucket we focus on is healthcare. The second big bucket we focus on is business services. And specifically within that, we spend a lot of time in trade services as well. So we'll look at HVAC, we've looked at roofing, gutter cleaning. The whole notion of what we're trying to do is invest in critical services that will always exist, no matter what. No matter what technology is out there, no matter how the economy changes,
Right.
I'm still going to want some AC in the summer. I'm going to want it to work, and that's the thesis behind kind of what Silvermine is about.
Absolutely. Well, that's great. So when you're looking at a business, what makes a business interesting to you? In terms of where the business is, what the infrastructure looks like, what the revenue mix looks like, what the employee base looks like, what the client base looks like, what the owner dependency. What are some of the key characteristics that you're looking for in a business to invest in?
So it's a really good question. As we think about the businesses that tend to resonate with our investment profile, I'd say there are kind of two buckets. So one's like, what does the market look like? And that's typically work that we do before we even talk to the business. And that's everything I discussed before. Is it in a
Right.
sector we like, that we believe in? So moving that to the side, specifically look at the business itself. To me, one of the key components that it depends if it's a platform acquisition or an add-on acquisition. If it's a platform, my first question is always, what's the infrastructure of the business? How is it growing? Why is it growing? How is it growing? What are the organs in place to help it continue grow going forward? And that can be a sales force, that can be your CRM system. That's always a key question. Another key question is, the quality of the service, right? That's obvious. If we're delivering a service of some sort, making sure that's delivered in a manner that we're proud of and that we want to grow and scale. And to that point, the third part is, what is the ability of this particular company to grow and scale, both organically with what it's doing today, but also inorganically as well? Those are kind of the three main questions that I ask when I look at a business. But it all kind of goes back to that first thing, which is what is it currently existing in the organization today that I and my partner and the employees, the company, and our partner, who's the CEO, can use to expand going forward.
For listeners that maybe don't understand or have as much knowledge, what's the difference between a platform investment versus an add-on, a tuck-in investment?
It's a very good question. So as I think about the differences between a platform or an add-on, a platform is, so from my perspective, so taking a step back, when I discuss that way, I'm talking about different ways to grow a business.
Right.
And so if my plan, I say it's really our plan. It's Silvermine's plan, but it's also the plan of the person that we're partnering with, is to grow through buying a bunch of different companies. We need a platform, so to speak, to start with. So when I talk
Right.
about a platform, that's what I'm referring to. And typically that platform is larger in nature relative to the alternative. And I define larger as, say, it's probably $2 million of EBITDA
Right.
profitability or
Right.
above,
Right.
probably over $10 million of
Right.
revenue. And it has the building blocks in place, the scalable
Right.
infrastructure, to take on more employees, to take on more customers. We can build that, but you save a lot of time by buying it first.
Right.
The other side of that is the acquisition, is the add-ons or the tuck-ins, and those don't necessarily need to have that level of infrastructure that I was talking about before. So as a way of example, if I have a platform HVAC business and I'm doing an add-on for it. Well, the add-on doesn't necessarily need to have all the corporate infrastructure. Really what I'm buying is their book of business and their recurring maintenance contracts and their
Right.
client relationships. So there's a lot more we can talk about kind of the differences there
Yeah,
and what
yeah.
is more or less important, but that's the way I think about it.
So I guess to repeat back what you just said. So if you're looking to get into the HVAC space, or you're looking to get into the roofing space, or you're looking to get into the irrigation space, a platform would be the initial investment that you're making with a company and a management team that's going to allow you to sort of get in that sector. And then you're going to build with and around that management team with additional acquisitions, maybe in the same geographical market, maybe in other geographical markets where you're sort of planting a flag. And so the platform is the initial investment. It needs to have some size, it needs to have some scale, it needs to be able to grow. And then the additional investments that you're doing once you have that platform established are going to be smaller companies that are going to be add-on tuck-in investments. Is that right?
That's well that's well
Okay.
said. That's exactly
Okay.
right.
So, um, if 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 you have a platform established and it's an HVAC, you're committed to the HVAC space, and you're sort of committed to the Mid Atlantic, Northeast, and you found a platform that's a backable team. As you're looking for additional acquisitions to sort of build out your holding company, what size of companies would be appropriate as add-ons or tuck-ins to that platform that's established already?
It's a good question. And as I think about it, I guess the appropriate size, it can be any size, right?
Any size.
It can be in the tens of thousands of it can be in the tens of thousands of EBITDA. It can be in the multi-millions of EBITDA,
Yeah.
and
Yeah.
obviously one is more transformational than the other. Because there's also another part to an add-on as well. The way simplistically I always think about it, I'm acquiring profitability and what
Right.
that entails. The other
Right.
side is I could be acquiring know-how or service
Right.
line. So
Right.
as an example, if I have an HVAC business and I decide I want, and you probably would not do this, but I decide I want to get into pest control for whatever reason, right?
Right.
So I'm going to buy a small pest business that, like, maybe it doesn't move the needle for me financially, but I'm now adding this service line and this capability
Okay.
that potentially has some cross sell opportunities. And so
Okay.
that's size wouldn't really be a
I get it.
relative
I
factor.
get
It's
it.
more
I
of
get
what's
it.
what I'm buying. But that's kind of a nuance to it. Mostly it can be any size.
So, talk to me about sort of your point of view of what you want the revenue mix of the business to look like. How much new construction is acceptable? How much would you like to see the replacement in the service and maintenance be of the total revenue component?
It's a very good question. As I think about revenue mix, different investors are going to have different viewpoints here. So when I'm
Right.
speaking about this is just Matt's viewpoint,
Right.
just based on some things I've seen and all that. As I think about it, to me, the golden prize is as much maintenance revenue as possible, and the reason is because that is recurring.
Right.
Because every year, like, we'll stick with the HVAC example, but the same is true for gutter cleaning. I should have mentioned I've been an investor in an HVAC business and a gutter cleaning business and propane, so I'm relatively familiar. The recurring revenue is durable, right? So as
Mhm.
I think about growing the business, I know that year in and year out, I have this base of maintenance or delivery or whatever it is that I can grow from. As you get further and further away from that, you can say, okay, well, look, I know that let's pick HVAC again. Every 5 to 10 years, probably five's on the low end, but probably every couple of years or so, you're going to need to replace your system. Okay, there's a replacement cycle there. So
Right.
I might not have that same customer every year, but I know that each and every year I'm going to have this coming back. The furthest end of that would be new construction, which is really a one-time thing, and the relationship you have there is with most likely a contractor versus a resident. So
Right.
I tend to think about it, I tend to like more maintenance. I'm okay with retrofit, and I tend to want to keep that new construction piece as long as possible. What does the ultimate split look like? Well, it depends on the industry, right? If I have 50% maintenance in HVAC, I mean, that's amazing. That's top of class. That is pretty hard to find.
Right.
Usually you see it as, call it 60-40, maybe 75-25 retrofit replace versus maintenance.
And when you look at the deals that you've done historically, are the sellers is the motivation behind the seller, is it an owner in his 60s that he's looking to retire? Is it an owner in his 50s where he's looking to maybe sell a piece and stay involved and sort of get the second bite of the apple? Is it a 30 to 40-year-old that's a young Turk that wants to tackle the world? I mean, um, where are you finding sellers in sort of their life cycle historically?
All of the above. I mean,
All
as
the
I kind
above.
of think about the sellers we work with, within the last 6 months, I spoke with an owner of a plumbing business. He was 32, right?
Right.
Young guy.
Right.
Built a $3 million EBITDA plumbing business in like 4 years. So
Wow.
that'd be like one example. And then I would say that's not common, right? The more common is it's somebody in their 40s, 50s, or 60s that I would say the younger you are, your motivations for selling are probably different, right?
Right.
Maybe you want to diversify a bit, take some chips off the table, but you probably want to keep running. And I'm just speaking general with what I've
Yeah.
seen. As people get older, usually it's to transition out and take a step back. And at Silvermine, the structure of the deal changes, but we're okay with all of it, just as long as we know in
Right.
front.
Right. Right. Let's talk about deal structure. The way that we describe it to sellers, there's a cash component, there could be a note component, there could be an earnout component, there could be some rollover equity component. Are you using all of those avenues from a structuring financing standpoint? And is there some combination that you prefer over another combination?
It's a good question. I mean, I'll give a direct answer, but it really depends on kind of what the situation is, what the owner wants, and what our plans are. And
Right.
so I would say the standard structure that, and again, this is very specific to not just Silvermine, but
Right.
me. And so my advice to listeners is like make sure you get to know the partner at the firm that you're talking to, because a lot of people do it differently. Here's how I just like to do it: is typically there's an upfront component. I generally always like to have a rollover component. What I mean by rollover is the person that is selling, they reinvest their equity into the new business into the business, into the new deal. And typically we can discuss this more, but that's on a tax-free basis. So there's no
Hmm.
tax penalty to that. And I
Hmm.
tend to like doing that because there's aligned interest in terms of what we're trying to achieve. And like if I hit a grand slam and I make 3 to 5 times my investor's money on it, I want the person that built the business to be able to partake in that too. So that's why I like rollover. And then there's maybe potentially an earnout component as well. And this is so specific, but typically in these processes, the owner will say, "Look, I think I'm going to hit $5 million EBITDA next year. I've got these contracts in place. I know I've got it set up, but I'm only at 4 right now." Well, in my mind, like, I want to pay you for 5. You did the work to get there; it just hasn't hit yet. So I'll say is like, look, lock it in. In a year from now, I'll give you more money once it becomes part of the LTM financials. So those are really the 3 components that I use. There
Right.
is a component. Some people do use seller financing.
Right.
We can discuss. I tend not to use that as
Yeah.
much,
Yeah. Yeah.
but people do that as well.
So if it's a $10 million transaction, using your example, it might be 60 to 70% in cash. It might be 10 to 20% in some sort of earnout. And then there might be another 10 to 20%, maybe 25% in rollover equity that the seller is leaving in the deal. Does that sound reasonable from a structuring standpoint?
Those are the exact numbers that I had. Yes, that's exactly what I would have said. I
And
would also
and
say
then if they're leaving 2 million in the deal and all goes well at the holding company level over a 3 to 5 year period, that 2 million that they're leaving in the deal, that could be worth another what range to what range in 5 years?
I mean, at a minimum, I will not do. I can't do a deal that I think is going to return us less than 3 times. So at a minimum, that
Okay.
would return $6 million. And the reality is, like, I want that to be $8 to $10 million. I'm really
Yeah.
shooting for four to
Yeah.
five
Yeah.
x. I would think about it.
So it's possible that that final check that they get in 3 to 5 years could be bigger than the cash check or the cash and the earnout check if all goes well.
Absolutely. That would
Okay,
be whenever I speak with sellers, that's actually kind of where I start with. Like, hey, you're going to reinvest this money here. Think of this as an investment where you're investing in me, and I'm gonna make you a lot of money doing this. And
right, right,
here's
right.
what I'm going to do.
Okay, okay. So, let's say, the seller's decided he wants to sell the business. He hires someone like us. We run a process. We talk to a bunch of guys like you. He's got a bunch of offers, and he's sort of comparing the offers in terms of, the top number, the deal structure number, and then he's sort of, thinking about conversations that he's had with buyers and what the buyer's experience is and what their background is and what their culture is and what their vision is. If he's down to either you versus, a couple of other guys, what are the points that you want that seller to really think through as to why he should select Silvermine as opposed to some of these other competing offers that are, from a valuation standpoint and structuring standpoint, within spitting distance of each other?
It's a good question. And to me, it comes down to what makes, again, it's a specific question to Silvermine, but what makes Silvermine a bit different. So if you leave kind of the structure and
Right,
the money piece aside,
right,
as I kind of think about it, it's, what has Silvermine done in the past? We talked about that there's
right,
typically a rollover component. Well, why do you trust Matt and Silvermine to triple, quadruple, quintuple your
right,
money here? Well, it's because we've, done the actually, I mean, we've probably done 30 investments over the course of my partner's career. At previous jobs, I was responsible for investing about $1 billion. I've returned 4 billion. So I've done well, and I'd say as you think about financially, that's certainly a key component. If I were in their shoes, I'd say, well, what's your plan for doing it here, like specifically, and we'll walk through it. And maybe there's some things that okay, it's a slam dunk, and some things that are not. Well, let's talk about what's not. And then I would say the third piece is it goes back to the Silvermine mission.
right,
Look, we're gonna the way I approach these things when we invest in a founder's business or a family business, like this is your baby. Now you built this. There's blood, sweat, and tears in this, and I want to grow it and I want to expand it, and I'm going to treat it with the respect that it deserves. And it goes back to Silvermine's culture. We're going to keep
right,
investing in your people. Um, the way I think about it, my partner gets the credit for coining this phrase, but I love it. You can't cut your way to growth, and so for us, it's just continually investing in both the things that have made this specific company fantastic, and there are absolutely things that are, otherwise we wouldn't invest in it. And then it's also putting new money behind some different initiatives that, for one reason or another, may also enhance the growth as
right,
well. So
right. Okay, great.
that's how I think
Yeah,
about
yeah, makes sense. Makes sense. Okay, so we've run a process. We've gotten a bunch of offers. We've selected you guys. Once the offer is accepted, what are the steps from a due diligence standpoint that and from a legal standpoint that um, is entailed in the process, and how long does that process from the time the offer is accepted until we finally close on the deal? What's the typical time frame there?
it. Yeah, so it's a good in terms of time frame. It depends, but it probably ranges from 45 to 90 days. On the shorter end of 45 days, that's a scenario where I've probably known the company for a while, right? I've seen data before.
Right,
Well, the short way to say it is my business diligence is done.
right,
Where I pretty much know what I need to know. Then you have to do a quality of earnings. You can do that in probably 3 weeks or so if you're pushing it,
mhm,
maybe four.
mhm,
Probably some legal diligence. You're going to look at your top customers' contracts. You're going
mhm.
to make sure that the organization. So that's on the fast end. It extends further if it takes longer to get data, and it almost always does take longer to get data, right? Because the stuff we're asking for, it exists, but it's just not something that
Yeah,
typically
you
the
gotta go
owners
find
look
it, you
at.
gotta put it together properly. Yeah,
Exactly.
yeah.
So that's the ranges I think about it.
And so for those listeners that have never been through the process before, the quality of earnings component, what exactly is that and how is that performed?
So you're asking all good questions. So the quality of earning,
Quality of
it's a
earnings.
It's a very key work stream when you're doing a transaction. So I try very hard not to use finance terms, but I keep using this term
You're right.
EBITDA.
Right.
What I mean by EBITDA, it's effectively how much profitability does the company have? It sounds simple. That is a very complicated question to answer, right? Because as an example, right, you might have, well, I was spending money on this last year, but I'm not going to spend money doing that. Well, that's called an adjustment, right? You're going to adjust your EBITDA higher.
Right.
So the
Right.
quality of earnings does is they look at all of your previous financials. They go through your trial balances, and they basically dig deep into the guts of it, and they kind of repiece it back together to state this is what it looks like. And what it will also do is say, okay, here are some adjustments to it
Hmm.
to make your EBITDA either higher or lower, and it can be lower sometimes. And that's what the Q of E is. The buyers, so the person in my shoes, will almost always do a Q of E. Maybe in some cases you wouldn't, but I've always done it.
Right.
I've seen some cases where the sellers actually want to do their own Q of E.
Right.
And the reason why they want to do their own Q of E is because when they go out to market and they say my EBITDA
They
is
just don't
X,
want there to be any surprises.
no surprises, no questions. It's been validated by a third party firm. And so if Matt comes in, plus or minus what my
Right.
QV is going to say as well. So it makes for a more streamlined and straightforward transaction. It
You,
costs money, but that's
yeah,
something
yeah.
to do that.
No, no, of course it does. Do you ever run into situations where a seller's been running his financials on a cash basis and you guys want to look at the business on an accrual basis because it's a more realistic recognition of revenue and expenses. And then part of what that Q of E does is it converts the cash financials over to accrual financials so that there's an actual time aligned recognition of revenue and expenses that everyone knows is the proper number, because sometimes on a cash basis things can get out of whack because you can complete a job and then get paid in April, and that causes the revenue number to jump, but it was really work that was performed the previous year.
Absolutely. That's probably one of the key reasons why I do QB is to restate it in that kind of way. I'll give you an example where that came up recently. And I'm laughing about it. There was a great guy. He had a roofing business. He leased the building that he had from like his dad or his uncle or something, and he paid like 3 years of rent like upfront. And
Mm,
so there was cash P&L. There was
right,
no rent coming through, but he
right,
had just prepaid it, so
right,
it wasn't in the financials. And so to your point, you need to kind of state that stuff because going forward I will now be paying rent
right,
to this person.
right, right. So we get through the Q of E and we get through the legal and business due diligence part, and then now we've got legal documents that are being drafted. Who's responsible for the initial draft of the legal documents, and what legal documents are there, and then what does the seller need to do to get proper representation to review the legal docs that are being submitted to him?
Good question. So in terms of who's responsible for the opening draft of whether it's we can get into
Yeah,
an asset deal versus stock deal, but the APA or the SBA, there's typically an organizational
right,
agreement for the new entity, the LC
right,
agreement or the C corp agreement,
right,
and then there's an agreement for the rollover equity as well, if that's a component. So it's some folks want to want to have the pen, so to speak, and be responsible
right,
for that first draft. I'm always happy to do it. Because on our side we've done it a lot. It really depends.
right.
I would say the seller has the option, probably has the primary option to do it first or do it second. If they want to just respond to what we send, that's absolutely fine. It saves them time and money
Yeah,
to
yeah,
have us do it. But it's typically at their option how they want to do it. My very strong recommendation for all sellers of businesses is one, to absolutely have an attorney. And you'd be surprised how some folks sometimes think they don't need one. I would absolutely have one. And then two, I'd have an attorney that has dealt with transactions before,
right,
that
right,
has that level of experience. These documents are very complicated. They're very convoluted. Some things are standard, some are not standard. And it's just helpful having somebody by your side looking out for you who's been in the ring or doing that before.
Good, good. Okay. We get through the legal process, everything's done, we get to closing, everything's signed, money gets wired, um, we're high-fiving the room. The next day, it's the day after. What does life look like from the seller's perspective? What does life look like from the employee's perspective? What does life look like from the customer's perspective and from the vendor's perspective? What remains the same and what changes?
So I think so. First, there's also don't forget there's a big dinner. Just so you
A
got to
big
deal
dinner.
down to the big dinner too. So you can't. That's all. That's one of the highlights. So once you make it through all of that, it would depend on if the owner, the previous owner, I guess, is staying with the business versus if they're leaving. I would say even if they're leaving, typically there's a transition, and that transition can take place over probably in the low end 3 months.
Yeah,
I've never seen it discussed less than that, and the high end it could be 2 years, right?
right.
But I would say if the CEO is staying or the owner is staying, candidly, not much changes, right? If again, this is a Silvermine perspective, but if we are investing in the business as a platform specifically, um, uh, things worked, right? I don't want to change things that work great, and I'm a big believer in culture, and so I'm not going to want to touch anything that in any way interferes with this probably tremendous culture that the person has built. On the back end, I would say the areas where we do get involved, it's like maybe we'll look at the finance department. Because a lot of these companies, they have a bookkeeper, they have an accountant, but
Mhm,
they haven't really built that up yet. So I'll probably be the interim CFO in the beginning, just building that up, and
mhm,
we'll build some more muscle.
mhm.
But I would say from a vendor perspective, from a customer's perspective, from an employee perspective, really no change, especially if the owner is staying. Now, if the owner is leaving, the idea is that we would introduce whoever's taken over, gradually over time, so that that person can learn the culture, can learn the ropes, so to speak, can see how things are done, and that the changes that he or she would make would be incremental to the things that already make the company great. And what I mean by that is if we're gonna do a tuck-in acquisition, for example, well,
Mhm.
the platform needs to prepare to do
Right,
that, and
right.
the new CEO is going to have to make some of those changes, whether it's on the IT side or the accounting side. So those things might change, but the idea is not to touch frontline stuff; it's to touch some of the things behind the scenes.
Other than the finance area, are there, based upon your historical experience, having done lots of these deals, are there certain areas in the business that you guys want to dig into early on in order to, and I'm going to use the word professionalize the business, and I'm not trying to say that in a pejorative fashion, but are there areas that you're typically wanting to invest in and maybe tighten up that are areas that you can get some early wins in and some early gains in?
Yeah, it's a really good question. I can give probably an hour answer. I'm gonna
Right,
really try hard not
right,
to. In my view, there are different life cycles of a company,
correct.
right? You have the founding life cycle. You probably have getting up to $1 million of profitability.
Right.
And I think of the world in profitability, you probably apply this to, it's probably better set on revenue. It's probably up to $5 million of revenue.
Yeah.
Then you get to $10 million of revenue. The company has to kind of reinvent itself a little bit to handle that. Same thing, 10 to 25 and 25 and above. So the answer is depends kind of when we're coming in, and where that company
Right.
is. Because a lot of what we do is what the company does today in every case clearly works for what it's doing today, but it's preparing it for tomorrow as it goes on that evolutionary life cycle.
Yeah.
And so the specific answer depends on the industry, but a lot of times
It
we'll do what we
depends
call
on where the business is in that growth cycle and where you need to invest in order to get it to the next level.
exactly. As an example, when in pest control, right? As I think about it, at $20 million of revenue, you need to implement NetSuite.
Right.
Before that, you're probably fine not having it. Above that, you're
QuickBooks is
really
working
not
at
having
that point. Yeah.
it. And so those are changes. If we're going to come in there and it's a 25 of revenue doesn't have that, well, okay, things are working today, but I bet you 26 are revenue. So like things are going to, the wheels are going to start coming off a little bit, and we're going to want to grow it fast. And so we might jump in there. So what we'll do is we'll go in there, we'll evaluate, okay, what's your IT system today? What's your reporting structure today? Like if is the CEO doing everything himself? And a
Right.
lot of times that's the case. These people are rock stars. Okay, well, we need to like decentralize some command here for just to help you scale. So we'll look at the IT systems. We talk about financials. We'll look at the financial systems. We'll look at, I say reporting structure. What I mean by that is the like if you have like 5 locations, like one GM managing those
Yeah.
5,
Yeah.
probably not scalable, especially
Yeah.
as we add, as we double it. And so start thinking through things to do like that. I would say anytime we decide to do something like that, it's not the person running the business. It's I like to think I like football, right? They're the quarterback and they're the coach. I'm the GM on the sideline. I'm sharing ideas. I'm happy to bring in some star talent to make this thing work, but they're running the ball here and they're going to win the game. And so it's really a joint effort based on the experiences that me and my partners have had, but more importantly, the experiences that the person running this business
Yeah.
has had as well.
Yeah. Maybe you've seen this, maybe not, but one of the things that we've developed over time is we think of businesses falling into different categories based on the size of the business. And um, we've got 7 different levels that we talk about. We've got a level 1 business that's doing less than 500,000 of revenue, a level 2 business that's doing less than a million, a level 3 business that's doing less than 2.5 million, a level 4 business that's doing less than 7.5, a level 5 that's doing less than 15, a level 6 that's doing less than 50, and a level 7 that's doing more than 50. And as companies go through each of those levels in their growth sort of trajectory, the revenue changes, the number of employees change, the cash flow changes, departments are formed, owners' responsibilities change, the infrastructure changes, and I think, um, to your point, an owner needs to think about where he is. An owner needs to think about where he wants to get to, and an owner needs to visualize what that, if he wants to build a $10 million company, he needs to think about what a $10 million company looks like. It's going to have 40 employees. You're going to have departments. They're going to report up to the CEO. I mean, that's a much more complicated business to run than a $2.5 million business with 12 employees. And so when he visualizes, this is what I'm trying to get to, this is where I am, I've got to build a map of how I get from here to there. And it's not just the revenue and it's not just the profit. You've got to build the infrastructure internally in terms of people, in terms of the org chart, in terms of the tech stack, in terms of reporting structure. I mean, there's a lot of work that needs to be done step by step. And so what you're doing is you're catching a business at a certain stage, and you're putting the infrastructure and the foundation in place to allow it to get to the next level, into the next level, into the next level. And it's all building the business along what that growth trajectory is.
Absolutely. My job, right? Like why people trust me to invest their capital is to do exactly that, right? It's not the quick way to say is, "Oh, I'm just going to help grow the business." Well, that's great, but there's I forget who said it, but a famous investor basically said a successful company is a master at reinventing itself over and
Right.
over and over
Right.
again, right? A company, to your point, a company 50 of revenue looks very different than a company at a million of revenue. And at some point, that $50 million revenue company was a $1 million revenue company. It
Sure it
just
was.
kind of evolved past that.
Sure it
And
was.
so, to me, the real magic is you want to keep what made that probably local company successful at $5, $10 million revenue as it continues to grow and scale. But there's no another example is as you break, and this to me, I think of this as an EBITDA. I just think of a $5 million EBITDA business needs a call center after that point,
Right.
right? Because it's just getting so much scale. You have so many customers that you're touching. You got to bring that in house. Well, as you get to 25 EBITDA, you need multiple call centers. You need someone to manage those call centers. And a call center business is very different than an HVAC business. So you obviously have many business units inside this larger
Right.
infrastructure,
Right.
and so and that needs to continually reinvent itself as the company gets larger. And that's the hard part of growing a business. It's not bringing on more customers, right? There's a lot of tricks to do that. It's actually building the infrastructure so that as you're sprinting, you don't run out of breath.
If we've got listeners that are not ready, they know they're not ready to sell the business yet, and they know the business is not ready to be sold yet. And let's say it's a $2 million business revenue wise, and they want to build it to a $10 million business, let's say. What are the two or three areas from your perspective that they really need to focus on to build that business that can scale to that point, has the value that the seller wants, and it's a desirable business for someone like you to purchase or to partner with? What are the areas that seller really needs to be focused on?
So it depends on what I'll give a very holistic answer. It depends on what the goal is. Some see if the goal is to sell the business at some point, that is a different answer than to say I want to get to $2 million of EBITDA and just hold on to it and make an annuity. Right? You're building two
Right.
different things there.
Right.
I would say if the goal is to grow it and sell it, the first question I would say is, okay, what do I want to be when I grow up? Right? I want to have we're talking, we'll go to the numbers we talked about before. I want a 40% maintenance business, 60% retrofit. Okay, what do I have to do to get there? And I would kind of roll back and take it step by step. Well, to do that, I need to have a maintenance program. Okay, well, I don't have a maintenance program, right? So I'm going to set up a maintenance program. And then as it gets bigger, I need someone to run the maintenance program. And I need a sales guy to focus on the maintenance program. And so I would say start with kind of what you want to be big picture and then kind of roll back into what that looks like. If you're building it to sell it, again, this is a Matt answer. I would say focus on, don't take business that is low margin, whatever that means in that
Right.
specific industry, right? So if in commercial HVAC, commercial specifically, gross margin is probably 30 to 40%. I wouldn't take on work that's 20%. You might make money doing that, and so if you're building it just to own it, sure, that's great. But I'm going to look at that and say, well, this business is low margin, right, relative to your competitors, right? That's hard for me to reconcile. So I would think intentionally about things like that. I would, again, this is a mad answer. I would focus on putting the building blocks in place so that when you talk to an investor, you can say, I have the ability to be a platform. And here's why. I already have NetSuite. I've already started getting a
Right.
call center. All of that is really hard. And so a lot of times, and founders ask me, so like, hey, Matt, what can I do to grow the business? The question I say is, well, you can do all that. How long is that going to take you? Is that going to take you 10 years? Is that going to take you 5 years? And is that what you want to be doing? And when people start thinking about that, you've got a group of people that say, yes, that sounds amazing. I want to do that. That sounds fun. And you have another group that says, well, I don't want to wait 10 years, right? I kind of want to do that next year. And I would say for those folks, it probably makes sense to talk to a professional investor who that's kind of all they do for a living, and they can help you kind of grow and scale on the line.
Perfect. Perfect. If someone's thinking about selling their business today, what's the question? What advice would you give them that they're not hearing from somebody else? Or what question would you encourage them to ask themselves as they're going down this journey that they're not thinking of asking themselves? Is there, do people just get sucked into this? I need to sell because all my buddies are selling, and there's stuff that they're not asking and they're thinking through that they really need to be asking and thinking through, that no one's pushing back on them.
Interesting. I think there's a few things, and the way I'd answer it is, what would I ask myself if I had a business? And I'd say, one, why am I selling? And
Right.
you'd be surprised, like, because to your point, a lot of folks say, like, well, yeah, my brother Bob sold his pets business. So I'm going to sell mine too. I'm going to make a lot of money. Okay, well that's great, but are you selling it because like you don't really want to work anymore? Like you built this business, you want to take a step back? Are you selling it because literally all of your money is invested in this business and you want to take a step back? So I would say like have like a very, and it could be all of the above, but like what's kind of driving you here? And the second question tied to that is, well, what do you want out of this transaction? Right? Do you want, I want to make $1 million and like that's all I care about and I'm going to go home and retire? Or it's like, I want to make $1 million and I want to be part of the next journey as well. I want to be the CEO of a $100 million revenue business and I just need help getting there. And so I would say that's then, and interesting, people don't think about those lines, and it comes
Right.
out in the transaction. Because the question I'll say is, I'll say, okay, do you want to stay involved with the business? Oh, well, I'm thinking about it. Oh, okay, you're welcome to think about it. You're getting to know me. I'm getting to know you. I understand. But in your heart of hearts, like, what do you really want? And that to me, it's a very it's philosophical for a lot of folks. But that's the key thing. And I would say the next part is, what do you want this business that you've either inherited or that you've built? What do you want it to be? Right? Do you want it to be one of the biggest HVAC businesses in the country, right? Do you want it to be the master of the region, really well known for their crafts? Do you want it to continue to be a small local business that everyone in town loves and you sponsor all the baseball teams? And those are the path to get to those three are very different. So those are the three questions, and the answers are very individual to whoever the person is. But those are probably the three questions that in their shoes I would be thinking about.
That's
I'd
very
actually
nice.
I'd answer a fourth part is how hard being a private equity backed CEO. Something we could talk about. That's a different job than being the CEO of your family business, right? They entail very different things, right? Basically, you have a boss. You got the P firm, whereas you didn't have that before, right? The P firm wants to grow, whereas before that probably wasn't as big a concern. So I would say the fourth part of that is, okay, you want to stay involved. What does that mean in terms of your involvement? Do you want to be a private equity backed CEO, or do you want to be the head of sales or the head of business development? A lot of folks want to be the head of business development and just be responsible for growing the business. So that was a lot. That was a mouthful,
No,
but
that's good
those are the
stuff,
questions I
man.
would have.
That's good stuff. Well, listen, this has been great. And we appreciate your time. You've given us great insights and a lot of points to think about. I'll put your contact details in the show notes, and people can track you down if they want to have a conversation with you, or they can come through me and I can set up a call. I appreciate your time so much, and look forward to talking to you again.
Likewise, appreciate you having me. Appreciate your graciousness and all the good questions. And anybody who wants to chat, I'm always happy to hop on the phone or
Okay,
Zoom.
dude. Thanks so much. Have a good day.
All right.